Welcome back to Today Assets Report, the channel where we cut through the noise, decode the data, and give you the analysis that actually matters. I'm glad you're here today because what we're about to cover is not your typical price prediction video. This is something different, something that connects dots most people in this space aren't even looking at. In the early hours of the morning, while most of America was still asleep, something happened in the crypto market that wiped out $2.3 billion in under 90 minutes. Just gone. And while retail traders were waking up to red portfolios and hitting the sell button in a panic, a single wallet, one that hadn't made a single move in 14 months, quietly absorbed 847 million XRP through a series of over-the-counter transactions that never once touched a public exchange. Let that sink in. Someone moved nearly a billion XRP in the shadows off the radar while everyone else was in full panic mode. That doesn't happen by accident. That doesn't happen without a reason. And today, we are going to talk about exactly what that reason might be. Because what I'm about to show you connects a Pentagon deployment order, a warning from the Treasury Secretary, and the most aggressive institutional accumulation event I have tracked in 3 years of covering this market. If you are holding XRP right now, the next 72 hours could be more important than anything you've experienced in this entire cycle. Voice. Let's start with something that most people in the XRP community are completely missing. And it's not because the information isn't out there, it's because most retail holders are staring at the wrong screen entirely. They're watching candlestick charts. They're refreshing their portfolio apps every 20 minutes. They're asking when moon in Telegram groups. And while they're doing all of that, something far more consequential is unfolding in the background. There's a pattern I've been tracking for years that I call the suppression accumulation cycle. And once you see it, you cannot unsee it. Here's how it works. Financial institutions don't react to news the way retail investors do. They don't buy the green candles or panic sell the red ones. They don't let fear drive their decisions. Instead, they position themselves before news becomes public knowledge. They don't chase breakouts. They actually manufacture the fear that creates the entry points they need. Think about that for a second. The fear you're feeling right now, the uncertainty, the frustration, that is not a side effect of market conditions. For the biggest players in this game, that fear is the product. It is the tool they use to shake retail holders loose so that institutions can step in and absorb supply at the exact prices they want. And the on-chain data right now is showing us something extraordinary that almost nobody is talking about. Voice. Here are the numbers that matter. Over the past 10 days alone, exchange reserves for XRP have declined by 3.2 billion tokens. 3.2 billion. And here's what makes that figure so significant. Retail has actually been net selling throughout this entire period. So if retail is selling and exchange reserves are still dropping, where is all that XRP going? It's being absorbed through OTC desks, through private bilateral agreements, through institutional channels that simply do not appear on the order books you and I are watching. This isn't speculation. This is what the on-chain data tells us when you know how to read it. David Schwartz, Ripple's chief technology officer, said something recently that most people completely glossed over. He mentioned that the infrastructure being built around XRP isn't designed for today's market. It's being built for a market that most participants can't yet imagine. Read between the lines on that statement, because it's important. The people who are building XRP's utility layer are not optimizing for a $2 token. They are constructing financial rails designed to move trillions of dollars. And the mathematics of moving trillions through a fixed supply asset has only one logical outcome for the price, and it's not where we are today. Voice. Let me walk you through the math that most retail investors completely ignore because it requires thinking beyond tomorrow's price action. And this is where geopolitics enters the picture in a way that most crypto analysts aren't even attempting to explain. The Strait of Hormuz, the narrow waterway sitting at the center of the current military escalation in the Middle East, handles approximately 21 million barrels of oil every single day. That's roughly 21% of the entire world's daily oil supply passing through one geographic choke point. Now let's translate that into financial flows. At current oil prices, you're looking at approximately $1.7 billion in oil value moving through that strait every single day. But the real numbers, the ones institutions actually care about, live in the financial instruments that price, hedge, and settle that oil. The global derivatives market sits at approximately $1.2 quadrillion in notional value. Cross-border payments total $150 trillion annually. The daily forex market alone moves $7.5 trillion. These are the numbers that put XRP's potential role into sharp focus, and they're the numbers the institutional world is quietly running right now. Voice. Here is the math that institutions understand and that retail investors consistently ignore, and it is so simple once you see it laid out. If XRP is priced at $2 and you want to move $10 billion in value through the network, you need 5 billion tokens to do it. 5 billion. That's nearly 10% of the entire liquid supply of XRP for a single transaction. The slippage would be catastrophic. The settlement would be wildly inefficient. The use case simply wouldn't function at that scale. But change the price to $50 per XRP, and that same $10 billion transaction requires only 200 million tokens. At $100 per XRP, you need just 100 million tokens. This is not a price prediction. This is a design requirement. The institutional infrastructure being built around XRP for large-scale settlement doesn't just prefer higher prices. It mathematically requires them to function efficiently. When you understand that, the question of whether XRP goes higher stops being a matter of opinion and starts being a matter of engineering logic. The people building this system aren't hoping for higher prices. They're building a system that structurally demands them. Voice. Now let's talk about supply, because this is where the story gets even more compelling. XRP has a fixed maximum supply of 100 billion tokens, a number that never changes, ever. Ripple's escrow currently holds approximately 38 billion tokens, with monthly releases that largely get relocked back into escrow. When you factor in lost wallets, tokens that have been effectively burned, and long-term institutional holdings that are essentially frozen, the estimated liquid supply available for actual market transactions is somewhere in the range of 35 to 40 billion tokens. And that liquid supply is now being absorbed at a pace that daily exchange volumes simply cannot replenish. Think about what that means in terms of basic economics: fixed supply, declining liquid availability, accelerating institutional demand. There is only one direction that equation resolves, and it doesn't require any leap of faith to reach that conclusion. It just requires understanding how supply and demand works at the most fundamental level. This isn't hype. This isn't hopium. This is the structural reality of what's happening in the XRP market right now, and most retail holders are completely missing it because they're focused on the daily price candle instead of the broader architecture being built around them. Voice. Let's talk about institutional validation, because the signals on this front have never been stronger, even as the retail sentiment narrative tells a completely different story. Ripple recently completed its acquisition of Hidden Road, one of the largest prime brokerage firms serving institutional clients, in a deal valued at $1.25 billion. Now ask yourself this question honestly. Does a company acquire a prime brokerage firm of that size and caliber to facilitate transactions at current market prices? Or does that acquisition only make economic sense if projected transaction volumes will require infrastructure that doesn't yet exist at the scale being prepared for? Because those are the only two possible answers, and only one of them explains why a company would make a move of that magnitude. Then there's BlackRock, the world's largest asset manager, with $10 trillion under management. Their CEO, Larry Fink, has publicly shifted from referring to Bitcoin as an index of money laundering to describing tokenization as the next generation for financial markets. That is not a casual opinion change. That is a deliberate repositioning statement from the single most influential figure in institutional asset management, and it signals a fundamental shift in how the largest pools of capital on Earth are beginning to think about digital assets and settlement infrastructure. Voice. And the institutional signals don't stop there. The Japanese Financial Services Agency recently reclassified XRP in a way that opens doors for full banking integration that simply wasn't possible under the previous regulatory framework. Japan processes trillions of dollars in cross-border payments annually. This reclassification was not bureaucratic housekeeping. It was preparation. It was a regulatory green light being given to one of the world's largest and most sophisticated financial ecosystems to begin integrating XRP-based settlement infrastructure into its banking operations. At the same time, Treasury Secretary Bessent stated publicly that the United States will retake control of the Strait of Hormuz and ensure freedom of navigation through that waterway. And most people read that as a geopolitical headline about oil, but here's the connection that almost nobody is making. When the United States projects military force to control global energy routes, they are not just protecting oil supply chains. They are defending the dollar's role as the world's reserve currency and primary settlement mechanism. And maintaining that dominance requires financial infrastructure that can move faster, settle cheaper, and operate more efficiently than any competing system on the planet. Voice. XRP was not built as a speculative asset for retail investors to trade on exchanges. It was built as settlement infrastructure designed to move value between financial institutions at scale, at speed, and at minimal cost. And settlement infrastructure becomes most valuable precisely during the moments when global financial systems face the kind of stress we are watching develop in real time. Let me give you the historical timeline that every XRP holder needs to understand before the next 72 hours unfold. The Pentagon has deployed tens of thousands of additional troops to the Middle East in under 2 weeks. Paratroopers are arriving, carrier groups are repositioning. This is not a routine patrol deployment. This mirrors the exact military staging pattern that preceded Iraq, that preceded Afghanistan, that preceded every major ground operation in modern American military history. Iran has made their position unmistakably clear. Their foreign ministry has publicly stated that any nation cooperating with the United States for defense purposes in the region is making a disastrous miscalculation. Missiles are being launched even as negotiations are supposedly continuing. The U.S. says talks are ongoing. Iran publicly denies it, and the military buildup continues to accelerate on both sides. Voice. When you have one side saying we will never surrender control of the Strait of Hormuz and the other side saying we are going to retake control of it, there is only one way that equation resolves, and it is not through a press conference. Here is the historical pattern that every single person watching this needs to internalize right now. Every major military conflict in recent history has been accompanied by an immediate and sharp sell-off in the crypto market. When Russia invaded Ukraine, Bitcoin dropped, XRP dropped, the entire market dropped. Hard and fast. But what happened in the weeks and months that followed every single one of those drops? The market didn't just recover, it overcompensated to the upside. The initial panic was real. The price decline was real. But the rebound occurred because the market ultimately realized it had dramatically overpriced the actual risk. Capital flooded back in, often faster than it had left. And the people who benefited most from those rebounds were not the ones who panic sold during the fear. They were the ones who held firm, or better yet, accumulated more, during the period when everyone else was selling. Voice. If a ground operation begins within the next 1 to 3 weeks, which every military signal we're tracking suggests is the likely timeline, the sell-off in XRP could push prices down to support levels that haven't been tested in months. And this is where the supply dynamics start to look radically different from what most people are assuming. Most retail holders think about XRP purely in terms of price. What is it worth today? Will it be higher or lower tomorrow? But institutions think about it in terms of availability. And right now, exchange reserves are quietly and consistently draining. XRP is being moved off of public exchanges into private wallets, into OTC desk holdings, into institutional custody solutions that never appear on the order books that retail traders monitor. When a significant token position enters a multi-signature institutional vault, it does not come back to market for a 10% gain. It is not positioned for a quick flip. It is held for utility. It is held for settlement purposes. It is, for all practical purposes, gone from the liquid supply that retail investors can access, and that changes the supply-demand calculation for everyone who remains in the market. Voice. Let me make this personal for a moment because I think it matters. If you are currently holding 1,000 XRP, you are positioned above where the vast majority of the world's population will ever realistically be able to accumulate. At 5,000 XRP, you are in the top fraction of a percent of all global holders. At 10,000 XRP, you are holding a position that, If even a modest fraction of the institutional use cases being built right now come fully online, represents something that most people will look back on years from now with genuine disbelief that they had the opportunity and didn't take it or didn't hold it. The people who accumulate during fear-driven dips, during exactly the kind of geopolitical and market uncertainty we are watching unfold right now, are consistently the ones who end up on the right side of structural market transitions. We are moving from an era of abundance to an era of scarcity in terms of accessible XRP supply. The window where retail investors can realistically accumulate at current price levels is not permanent. Once the catalyst arrives, the risk premium that's currently keeping prices suppressed disappears, and prices can gap upward in ways that don't offer clean re-entry points. Voice. Federal Reserve Chair. Jerome Powell just added another critical layer to this story that the mainstream crypto conversation is almost entirely ignoring. He stated on record that U.S. federal debt is growing substantially faster than the economy and that the current trajectory is, in his words, unsustainable. He said directly that if nothing changes soon, it will not end well. The chair of the Federal Reserve is telling you, in plain English, that the U.S. financial system is on a path that cannot be maintained. And here is the question that naturally follows from that statement. What does the United States government historically do when their currency faces pressure, when their debt load becomes untenable, and when their economic dominance is being challenged on the global stage? They project military force to control critical resources, they work to funnel capital back toward dollar-denominated systems, and they accelerate the development and deployment of financial infrastructure that reinforces American settlement dominance. XRP sits at the exact intersection of all three of those responses. That is not a coincidence, that is architecture. Voice. Now I want to speak directly to the frustration, because I know it's real and I think it deserves to be addressed honestly rather than glossed over with motivational platitudes. You've been holding through dips. You've been holding through sideways price action that seems to go nowhere. You've watched regulatory delays, market corrections, and headline after headline that promised a breakout that came and went without the sustained move you were expecting. You check your portfolio and you genuinely wonder whether you're the smart money in this situation or whether you're the one holding the bag while someone else exits at your expense. I'm not going to dismiss that frustration. It is completely valid. Every serious long-term holder in this market has sat in that exact emotional space at some point. But here is what the historical data actually shows. And this is not a pep talk. This is a documented pattern that repeats across market cycles. The period of maximum frustration, the period where the most holders give up, where capitulation reaches its peak, where people decide the thesis was wrong. That period is almost always the period that directly precedes a structural breakout, not a temporary price pump, a genuine fundamental shift in how the asset is valued by the market. Voice. The reason this pattern repeats so consistently is actually simple when you think about it. Institutions cannot accumulate at the scale they need to accumulate if retail holders are holding firm and buying more at every dip. They need supply to become available. And supply becomes available when retail investors become frustrated enough to sell. Your frustration is not a signal that your thesis is wrong. Your frustration is the mechanism by which the smart money gets the supply it needs to position for what comes next. While retail holders are focused on red candles and fear-driven headlines, the institutional world is signing non-disclosure agreements, building settlement infrastructure, hiring compliance teams, and quietly positioning for a version of this market that most retail participants genuinely cannot picture yet. Being early in a macro thesis always feels exactly like being wrong, right up until the moment the market catches up to the reality that early participants saw before everyone else. The only question that ultimately matters here is not whether XRP's role in institutional settlement infrastructure is real. The question is whether you will still be positioned when that reality becomes undeniable to the broader market. This is Today Assets Report, and we will keep watching this story every step of the way. Stay patient, stay rational, and stay ahead of the noise, because the data is telling a story that most people aren't ready to hear yet.